Today, we're tackling a tough truth. Studies show that 90% of retail investors, that's everyday people like you and me, lose money in the stock market. Why does this happen? Is the market rigged, or are we making avoidable mistakes? By the end of this video, you'll know the top reasons retail investors fail, plus practical tips to beat the odds. So, grab a coffee, hit that like button, and let's dive in. First, let's clarify what we mean by retail investors. These are individuals investing their own money in stocks, ETFs, options, or other assets, usually through platforms like Robinhood, E-Trade, or Fidelity. Unlike institutional investors, like hedge funds or pension funds, retail investors don't have teams of analysts, insider connections, or billions in capital. According to a 2021 study by the University of California, about 90% of retail investors lose money over time when trading actively. That's a shocking number, but it's not because the market is impossible to navigate. It's because of specific behaviors and mistakes. Let's break down the top 5 reasons why this happens. Reason number 1. Most retail investors jump into the market without enough knowledge or research. Investing isn't like gambling. You can't just pick a stock because it's trending on social media or because your cousin said it's going to the moon. For example, during the 2021 GameStop frenzy, thousands of retail investors bought in at sky-high prices, driven by hype on platforms like Reddit. When the stock crashed, many lost big because they didn't understand the company's fundamentals or the risks of short squeezes. Here's the truth. Successful investing requires learning the basics, like how to read a balance sheet, understand PE ratios, or evaluate a company's competitive advantage. Without this, you're flying blind. Pro tip: start with free resources like Investopedia or read classics like The Intelligent Investor by Benjamin Graham. Spend at least 20 hours learning before you invest a single dollar. Knowledge is your edge. Reason number 2, emotional investing. The stock market is an emotional roller coaster. When stocks soar, greed kicks in, and people buy at peak prices. When markets crash, fear takes over, and they sell at rock bottom. This buy high, sell low cycle is the opposite of what you should do. A 2020 Dalbar study found that the average retail investor underperformed the S&P 500 by about 5% per year, largely because of emotional decisions. For example, during the March 2020 COVID crash, many sold their stocks in panic, missing the recovery that followed. Why does this happen? Our brains are wired to react to short-term pain and pleasure, but investing is a long-term game. Pro tip: create a written investment plan with clear rules, like I'll only sell if a stock drops 20% for fundamental reasons. Stick to it, no matter how you feel. Or consider automating your investments through dollar-cost averaging to remove emotion entirely. Reason number 3, overtrading and high fees. Thanks to commission-free apps, it's easier than ever to trade stocks or options. But just because it's free to trade doesn't mean it's free to lose money. Retail investors often overtrade, constantly buying and selling to chase quick profits. A 2022 study by Schwab showed that active traders underperformed passive investors by a wide margin. Why? Because frequent trading racks up losses from bad timing and hidden costs like bid-ask spreads or taxes on short-term gains. Plus, some retail investors dabble in options or leveraged ETFs, which are high risk and complex. Without expertise, these can wipe out accounts fast. Pro tip: focus on low-cost, diversified investments like an S&P 500 ETF. Trade as little as possible. Think months or years, not days. And if you're paying fees, switch to a broker with no commissions and low expense ratios. Reason number 4, following bad advice. Social media is a double-edged sword for retail investors. Platforms like X or TikTok are flooded with gurus promising 10x returns or hot stock tips. But most of these influencers aren't financial advisors. They're entertainers, or worse, scammers running pump-and-dump schemes. For instance, in 2021 meme stock craze, some influencers hyped up stocks like AMC without disclosing they were selling at the top. Followers who blindly bought and got burned. Even well-meaning advice from friends or family can be dangerous if it's not tailored to your financial goals. Pro tip: verify any stock tip by checking primary sources, like a company's earnings report. Better yet, ignore tips altogether and build a portfolio based on your own research and risk tolerance. If you want guidance, Consult a fiduciary financial advisor, someone legally required to act in your best interest. Reason number 5, unrealistic expectations. Many retail investors enter the market expecting to get rich quick overnight. They hear stories about someone who turned $1,000 into $100,000 trading Tesla or crypto and think, why not me? But those are exceptions, not the rule. The S&P 500 returns about 7 to 10% annually on average, a solid return, but it's not sexy. Chasing home runs leads to risky bets, like putting all your money in one stock or using margin debt. A 2021 FINRA report noted that retail investors using leverage often lose more than they can afford when markets turn. Pro tip: treat investing as a slow, steady way to build wealth. Over time, diversify your portfolio across industries and asset classes to reduce risk. Aim for consistent returns, not lottery wins. And if you want to experiment with high-risk trades, limit it to 5 to 10% of your portfolio. So, why do 90% of retail investors lose money? It's not because the market's rigged. It's because they lack knowledge, let emotions drive decisions, overtrade, follow bad advice, and chase unrealistic dreams. But you don't have to be in that 90%. Start small, learn constantly, and stick to a disciplined, long-term strategy. Over time, you can build wealth and beat the odds. If you found this video helpful, smash that like button, subscribe for more investing tips, and drop a comment below. What's one mistake you've made as an investor? Let's learn from each other. Thanks for watching, and I'll see you in the next one. These are some other videos you can consider watching.